Welcome back to Muscular Brain, Fat Wallet. Today, we're tackling a major question that every smart investor must consider when the economy falters. Is real estate still a good investment during a recession? Recessions bring uncertainty. The stock market may drop, jobs are lost, and consumer confidence takes a hit. Real estate, however, has long been viewed as a reliable investment vehicle, one that builds long-term wealth. But how does it perform when the economy shrinks? Should you still put your money into property when things are looking grim? In this video, we'll take a comprehensive look at how real estate behaves in tough economic times, explore the risks and opportunities of investing during recessions, and offer strategies for smart decision-making. By the end, you'll have the knowledge to decide if real estate is still worth considering for your portfolio. Chapter 1: Recessions and their economic impact. To understand real estate's role in a recession, we first need to grasp what a recession actually is and how it affects the economy. A recession is typically defined as 2 consecutive quarters of negative GDP growth, but that's just the surface of what happens. Recessions lead to reduced consumer spending, slower business growth, and, crucially for us, lower interest rates. When the economy contracts, businesses struggle, and people may lose their jobs. With less disposable income, fewer people are able to make significant investments, including real estate purchases. As demand falls, so do property prices, often. But this isn't always a bad thing for investors, as we'll see. However, it's important to note that not all recessions impact real estate in the same way. Let's dive into a few historical examples to better understand the dynamics. Chapter 2: How real estate has performed in past recessions. Historically, real estate has shown resilience through many recessions, but not all property markets react in the same way. Take the Great Recession of 2008, for instance. This was primarily caused by a housing market collapse, so naturally, real estate prices plummeted. In this case, property was at the heart of the economic downturn. But other recessions, such as the one in the early 2000s following the dot-com bubble, tell a different story. In that scenario, while tech stocks crashed, real estate held its ground. Why? The collapse wasn't caused by housing, so property didn't take the same hit. In past recessions, commercial real estate tends to suffer more than residential real estate. When businesses shrink or close down, they no longer need office spaces, and vacancy rates skyrocket. Residential real estate, on the other hand, is often less volatile because people always need places to live. So, what's the takeaway from these historical trends? While real estate might suffer during a recession, it doesn't always crash. In fact, for those who know how to navigate these periods, recessions can create prime buying opportunities, especially when prices drop below intrinsic value. Chapter 3: Benefits of investing in real estate during a recession. Now, let's look at why real estate can still be a smart investment in a recession. First, recessions often lead to lower interest rates. Central banks, such as the Federal Reserve, typically lower interest rates to stimulate the economy. This creates a lower cost of borrowing, which makes financing real estate more affordable for investors. A lower mortgage rate can significantly increase your buying power or reduce your monthly payments on new properties. Second, during a recession, property prices often stagnate or fall. This can open the door for long-term investors to pick up properties at a discount. It's crucial, though, to differentiate between good deals and cheap properties that may come with too much risk, such as being located in distressed areas where recovery might take years or never happen. Additionally, while the stock market tends to be volatile during a recession, real estate prices usually experience less extreme fluctuations. This stability makes real estate appealing for investors looking for long-term security. While you may see your stock portfolio swing wildly, your real estate investment is likely to remain more predictable. Finally, real estate provides an ongoing income stream through rental properties. Even during downturns, people need housing. In fact, the rental market can often thrive during recessions as fewer people can afford to buy homes, leading to higher demand for rental properties. Chapter 4: Risks of real estate investing in a recession. Of course, there are risks to investing in real estate during a recession. Let's go over some of the main concerns you should be aware of. One of the biggest risks is the potential for falling property values. While it's true that prices may drop during a recession, they can also stagnate for years before seeing any appreciation. If you're banking on quick gains, you may find yourself disappointed. Another risk is reduced demand. As unemployment rises and consumer spending slows, fewer people are in a position to buy homes. This can lead to longer periods where properties sit on the market, waiting for a buyer. If you're investing in real estate during a recession, you need to be prepared for slower sales cycles. Vacancy rates in rental properties may also increase. While some rental markets may thrive during a recession, others might see higher vacancy rates, especially in areas heavily reliant on industries that have been hit hard by the downturn. It's important to carefully analyze the local job market and economic conditions before investing. Lastly, financing can become harder to secure for certain types of properties, especially commercial real estate, as lenders become more risk-averse during recessions. You'll need a strong credit profile or be prepared to put down a larger down payment to get favorable loan terms. Chapter 5. Strategies for smart real estate investing during a recession. So, how can you invest wisely in real estate during a recession? Here are a few strategies to consider. First, focus on cash flow. In uncertain times, cash flow is king. Look for properties that can generate steady rental income from day one, even if the price appreciation potential isn't immediate. Positive cash flow will help you weather the storm of a recession, ensuring you can cover your expenses even if the property's value doesn't increase in the short term. Second, target undervalued markets. Not all real estate markets are affected equally during a recession. Some cities and regions may be more resilient due to strong local economies, diverse job markets, or other factors. By identifying undervalued markets that are poised for recovery, you can position yourself for long-term growth. Another key strategy is to be patient. Don't rush into a deal just because prices have dropped. Do your homework, study the local market, and wait for the right opportunity. Sometimes the best deals come after the recession has bottomed out, so keep an eye on long-term trends. Lastly, diversify your investments. Don't put all your eggs in one basket. Consider investing in a mix of property types, such as residential, commercial, and even real estate investment trusts, REITs, to spread your risk across different asset classes. Conclusion: is real estate still a good investment in a recession? At the end of the day, the answer to whether real estate is a good investment during a recession is, it depends. If you approach it strategically, with a focus on long-term growth and cash flow, real estate can be a powerful tool for building wealth, even in tough economic times. However, it's not without risks, and timing is crucial. By understanding the market, keeping an eye on interest rates, and focusing on properties with strong fundamentals, you can make real estate work for you, even during a recession. It's all about being informed, patient, and prepared. Thanks for watching. If you enjoyed this deep dive into real estate investing during recessions, hit that subscribe button and join us next time on Muscular Brain, Fat Wallet, where we help you grow your wealth smartly, even in the face of economic uncertainty.